welcome to the special edition of The Global View with me, Tanveer Gill. My guest today on the show is Dr. Mark Mobius of Templeton Asset Management. He needs no introduction. When it comes to investing in emerging markets, his word is the final word. Dr. Mobius, thanks very much for taking out the time to speak with us, and welcome to Mumbai.
Thank you very much.
What brings you to Mumbai? Is it a very short trip, quick in and out?
Short trip, only 3 days.
Only 3 days?
Yeah.
Are you here to study the next multi-bagger from the small cap universe in India that you're so bullish on?
I'm always looking for the best opportunities.
Okay. Let me start off with asking you about how closely are you monitoring the implementation of the GST bill through the next 6 months. I know, a month back when we spoke, you'd highlighted that you were not very satisfied with the implementation process just as yet. The finance minister, however, has made his commitment to keeping the 1st April 2017 deadline. And the GST Council, they haven't really been able to draw consensus, but they're working very hard towards finding a solution to the rate structure as well as the compensation issue by early November. If all things fall in place, would that be reason enough for you to start increasing your holdings or your India allocation from the current 7.5% in your portfolio?
There's no question that it will take a lot more time than we expect. I mean, we knew that from the very beginning.
You don't think they'll keep it to the 1st April 2017 deadline?
I think it'll be very difficult to do that. It's wonderful that they're setting that deadline and they're going to try as best as possible to reach it. But I think it's being a little optimistic. Given all of the complications you're dealing with. You're dealing with, all these states with different requirements. Yeah. You're getting a lot of exceptions, et cetera, et cetera. So I think you have to think longer term. The direction is good. And the fact that they are moving in that direction and are setting deadlines for themselves is very positive. So that means we are confident to invest in India even at this stage. We don't have to wait until the GST is fully implemented. So I think the prognosis is very good.
The perception in the market is that early November, maybe they would be able to find some common ground when it comes to deciding on compensation, that cess that they're looking at for ultra-luxury and demerit goods, plus the 4-tier tax structure. The sound bites that you're getting as of now, doesn't that convince you that they could perhaps 11th hour, 59th minute make it?
No, I don't think that's possible because there's so many different forces at work that you can't expect a clean, immediate implementation of this system.
So what would be a reasonable timeline to your mind?
I think the end of next year.
End of next year?
Yeah.
So it'd get pushed back by like 8-9 months, you expect?
For complete implementation.
Okay.
Now, of course, in the meantime, there will be incremental changes taking place, which will be very beneficial. But I think to be realistic, we have to think longer term. Now, I'd be happy to be surprised. It'd be wonderful if they're able to do it before that. But I think it'll be a little longer than we expect.
The reason I ask you this is because you had told me that with the GST passage, you would look at doubling your India investments. Even in your last interview with me about a month back, you said that your allocation, India allocation, stands at 7.5-8%. The EM fund could go up to 14%, even 20% plus. So when would you start, increasing your allocations? What would you want to see to make that decision?
Well, you see, a lot will depend on what happens to pricing of the securities. When I say that, I don't mean just this absolute stock price, but also the earnings. If earnings surge, then we can justify doubling, tripling our allocation. And of course, when we talk about GST, we talk about what impact that has on the earnings of the companies. So I think we have to be flexible and look at each company on an individual basis and determine, what their earnings are going to be and what impact the GST is going to have on those earnings. In some cases, it'll be as much as 10% increase in earnings, and that could be very significant.
Yeah, I want to talk about that because even S&P has put out a note that if GST goes through as per plan, then India's potential of 8% plus would very much come to the fore. Do you agree with that?
Absolutely, I agree. Yes.
Yeah.
Full implementation.
Full implementation.
So this is very important.
So that you only foresee coming through from FY19 onwards.
Yes. Exactly.
What would that do for corporate earnings? Because you're foreseeing 12 to 15% earnings growth for FY17. That's what you mentioned is your broad expectation. With the GST coming into place, how much of that would get revised higher? Where would the earnings range move up to?
There'll be an incredible increase in earnings for many companies, as much as 20% you'll see in some cases. Okay. Now, when I mention that, what I have to emphasize is that with the GST, you now have a bigger market for many companies.
That's true.
So you're going to have consolidation of firms throughout the country, and you're going to have the growth of huge conglomerates, huge companies that will be world class and will be able to expand internationally at a much faster pace. So it's very important to emphasize that the consumer market in India is enormous, but it is now divided. It's segmented. With the GST, you'll see a combining of these forces so that you then have the rise of really huge consumer products companies, consumer services companies, etc. It can be very exciting.
So give me a range in that. I mean, how high could earnings growth go up by?
In the next 3 or 4 years, you can see 20, 30, 40% increase in earnings with the proper GST implementation.
Right, and again, a derivative of that would be what that does for market valuations. Again, you highlighted, and I was quite startled when you said, 20, 25 times a PE expansion, valuation expansion is very much on the cards. We're at about 17 times 1 year forward. That would mean a 50% strong rally from here.
Yes.
41,000 target for the Sensex, 13,000 nearly for the Nifty. All of it really rests on GST. What else can really take the markets higher?
No, there are a combination of factors here.
Yeah.
There's GST, but there's also interest rates. Don't forget, with very benign inflation, then you're going to see lower interest rates, which is meaning that you can justify higher PEs. So there's a combination of things. There's GST, impact on earnings growth, lower interest rates.
Cost of capital coming down.
All of these things combining to give an incredible push to stock prices.
Right. And how soon do you think that we would embark on that mighty rally? We are pretty much still trying to tease around the all-time highs. When do we go past that?
Middle of next year, probably, because by that time, the GST impact will really begin to feed into the system. Provided that everything goes the way we expect it to go.
Are you saying that by August of next year we would be at 13,000 on the index on the Nifty?
It's quite possible.
Quite possible.
Quite
okay.
possible.
Well, okay, I'll hold you to that once we come through into next year. But I just want to also talk about whether this outperformance in India, which largely seems like driven by domestic fundamentals improving, can happen in isolation to the rest of the emerging market world.
It can, because you can see what happened with China. China has surged ahead far faster than every other emerging market except India. And India now could become a leader and could really drive the growth of other markets. Because remember, the other thing that's happening is that as India opens, they will begin to see the impact of trade and investment into other markets around the world, particularly emerging markets. Already that's happening, but I think it'll happen to a greater extent going forward.
And I just want to put out this interesting data that you highlighted, that in the last 28 years, and you've been credited for making emerging markets literally an asset class, because you've known the markets from the word go. And in the last 28 years, the data suggests that 61% of the time, which is majority of the time, emerging markets have outperformed developed markets, barring the last 3 years. So I know historical performance is never really an indication of what happens in the future, but can one extrapolate that now is the time where for the next 20 years as well, emerging markets hold the potential to stand out?
I believe so. Of course, there'll be years when there is underperformance, but over the long term, no question in my mind that emerging markets will outperform. And India is a good example.
That's true.
India's growth is tremendous and will continue to be very fast.
Is that also the reason why, aside of looking at a horizontal view of the markets, which is essentially country allocations, large cap allocations, that now you're studying the depth of these markets and researching more on mid caps and small caps and unlocking value there, which is reflected in your Asian small companies fund, so to speak.
Exactly. Another thing that you have to remember that as the per capita incomes in India rise, more and more people will have access to stock markets, bond markets. Therefore, the liquidity, the turnover, the trading turnover of the small and medium-sized companies will rise. That will enable large funds to invest more frequently in those markets. And I think it's a very, very important factor.
And a lot of those companies which are family owned may also dilute equity, which would increase the total tradable equity in the market.
Exactly.
Again, bringing in more investors. On that very front, you know, in your small cap fund, and I was startled to see the performance. I have to reiterate for the benefit of our viewers, your small cap fund has given a return of 47% over the last 5 years, outperforming the benchmark, MSCI benchmark, by 12%. So, you know, that has been one standout performance. Dr. Mobius, India has more than double the benchmark allocation, which is essentially your top allocation as part of the small cap fund. Does that mean that India is a small cap treasure house for you, so to speak, you know, compared to the rest of the region?
We've always felt that because we see an incredible number of listed companies in India, and it's always been a tempting target. The problem has been liquidity. You know, the liquidity has not been there enough for us to make big investments. That's changing, and that's very, very exciting.
I know you're not going to talk stocks, though I would want you to talk stocks. But, you know, some of your holdings in the small cap fund are Bajaj Holdings, you know, you have Tata Chemicals, there is Vardhman Textiles, Federal Bank. Give our viewers, you know, for a lot of people out there, the perception with small caps and mid caps are that, you know, these are risky businesses, unpredictable business cycles, their management integrity issues, which is what private equity investors always crib about. And add to that, you know, these are promoter-owned companies. These are family-run businesses. Give them 3 ground rules that have never failed you while picking up a multi-bagger idea within the small-cap universe.
It's interesting. The names that you just mentioned probably personify the things I'm going to mention, the 3 things. One is very, very good management in the sense of people with integrity, people with good management know-how, people who understand the market, understand how to relate to investors, good corporate governance. I think that's number one, very, very important, which is why we do a lot of intensive research into the people behind these companies. The second thing is a vision for growth. In other words, a management that tells us, look, this is where we're going, this is where we expect to reach in 5 years, and we are on a growth path, and this is how we're going to achieve it. That's the second thing. And the third thing, an awareness of the environment, the country environment where they're working. In other words, as you know, in India it can be very, very complicated. The rules and regulations are very complicated in India. An awareness of how to work within that framework is very, very important, particularly in India. So I would say those are the 3 things.
And if I were to ask you, what is the one you know, segment or stock perhaps, because it's Diwali time in India, so, you know, if you could help our viewers with perhaps a Diwali gift and a stock idea, or, you know, a stock investment that has worked for you very well, or a, you know, segment that you're very bullish on within the small cap universe, that'd be great. Well, I would want to stop, but, you know, I'll leave it to you.
No, it's interesting that those names that you just mentioned represent a variety, 4 different sectors.
They do.
But I think one area that deserves mention is banking, because you have a growing country, which reflects on banks' earnings. You have a central bank who have been very astute and very disciplined in making sure that banks account for their non-performing loans.
Yeah.
So that combination is very, very positive. And if you compare it to other countries, it's usually not present in many other countries. So I would say the banking sector, and you mentioned Federal Bank, but I'm not recommending it because, you know, at any point in time we'd be...
You've just invested in it, Dr. Mobius. You're not recommending it.
So,
that's saying a lot.
So I think, you know, for people who want to get some insights, it's good to look at our portfolios because we don't trade very much. We don't.
That's true.
We're not in and out of these stocks very rapidly.
You know, you just gave me the cue for my next question. PSU Banks, you know. Do you think, and I was talking to Ajay about this before the interview, do you think that right now is perhaps the time to buy, and I say buy in block letters, B-U-Y, buy PSU Banks from a fundamental perspective, not from a trading perspective, because I know that they've held, you know, a lot of long-only funds that had trading positions in PSU Banks, you know, 3 months, 6 months to just generate that alpha on portfolios. But this is the time to really look at all the factors that are coming together for bringing about a fundamental shift in these banks, you know, to make them really get re-rated from here.
I believe that's the case. For the reasons I mentioned, the fact that there's now discipline in the banking system, central bank is looking at these banks very carefully to make sure that their capital requirements are where they should be. And secondly, remember there's so many people in India don't have bank accounts yet. And that's going to be growing with the identification card system coming into play. That would be very positive for these banks. And the fact that the country is growing, which always would be reflective in the banks.
Right, but for PSU...
Now, by the way, the provision there, though, is that we have to make sure these banks are going to be on par in terms of internet banking, to make sure that their technology is keeping up with the changes that are taking place in fintech.
Right, but right now the valuation discount that these banks have, we've seen a 3-month trading rally which has been strong, but they're still trading at a discount to large cap private banks, and that discount really reflects the fact that there still needs to be catch up on the NPA cycle recovering, right? On good capitalization, on them being able to step up on recoveries. Plus, add to that the fact that there needs to be revival in credit growth. So, do you think that we are on the brink of that happening? So I understand on the futuristic aspect, which is expansion and ensuring that there's forward integration with internet banking, essentially. But solving the problems that they are to get them to catch up with large cap banks, doesn't that hold ground? Like, isn't it changing more so than ever right now?
Yeah, I think it is changing because I believe the government is smart enough to realize that they cannot force on these banks policy decisions which will not be viable and profitable.
Yeah.
And I think that's very, very important, and which is why these banks will become more and more like private sector banks in the sense of the decisions they make regarding granting of credit, et cetera, will be more rational, if you might say.
Right, but on credit growth, you also hinted at that earlier in the interview. Do you expect more aggressive rate cuts from the RBI, and how many more perhaps in the offing? And when would that reflect in investment-led demand for loans, which is what banks need?
It is already happening. With the lower interest rates, as you know, there's been a trend towards lower and lower interest rates. You're seeing already an expansion in these grants.
Right, but under the new regime, do you expect more rate cuts than few?
Yes, I do. Yeah.
How many rate cuts do you expect? Okay, you don't want to put a number there, but suffice to say, the market is going with 25, 50 basis points at best. You expect more than that?
More than that, I think. Okay. More than that. Okay. Because the environment is so positive for that to happen.
Yeah, most
It's
definitely.
really interesting, the difference between India and some other emerging markets and what's happening in the U.S. and Europe. The U.S. threatening to raise rates, but in many emerging markets they're going down.
Absolutely.
Simply because we're not into negative rates yet.
True. Yeah, no, we have a lot of headroom on that front. IT earnings, TCS and Infosys said what they had to, you keeping your conviction there. Wipro's just made an acquisition. HCL Tech has delivered pretty much on expected lines, they've done well. You're an investor, you're keeping your conviction with the sector. My question is it time to make incremental investments in this space just as yet? Or would it be an entry point? Yes, if you're holding the sector, you would hold on to it. But does it make a case to evaluate it from a fresh investment point of view?
I wouldn't say that it's a good idea to increase at this stage. But it will depend again on the individual company. But more importantly, the changes that are taking place as regards to cloud, which has become a huge new area of growth for many companies, and what's happening in terms of the whole fintech development, what's happening.
The fintech boom.
The whole boom. And the degree to which these companies can adjust to that new environment is going to really be important, which is why this acquisition is a sign of the times, because a lot of that was driven for the reason of cloud, to get involved with cloud.
Is oil and gas seen as an investment which helps in capital protection? And I essentially want to, without talking about your investment, but I see Reliance Industries part of core portfolios in India and overseas. And again, I was discussing this with Ajay because he tracks the sector closely about the potential for the business. We haven't seen Reliance Industries move as a stock. So is it seen more as capital protection than capital appreciation in portfolios right now, till the whole geo play comes in?
I think that situation is changing. Oil prices are on the way up. I think it was about a year ago where I said I expect $60 a barrel, and I still stick by that. I think we're going to reach that.
By when?
And probably by the end of this year, beginning of next year. Okay. But then, if you look at Reliance and other companies related to the oil sector, what they've done is they've cut a lot of the expensive exploration and development, which has brought costs down.
Sure.
They're now much more rational in what they're doing in terms of new developments. And those companies that are on the retail side have done quite well because retail sales are increasing with more reasonable oil and gas prices.
Sure.
So that combination can be very, very positive for the oil sectors. Interestingly enough, if you look at the last 5 years, generally speaking globally, oil and gas sector has been very bad. And usually these sectors last about 5 years, and then they come back again. And that's what I think is going to happen with the oil and gas sector.
Okay, so we're at the brink of an upcycle there. Okay, let's talk about the one topic that everybody is talking about right now, which is the U.S. presidential elections. Clinton victory, Trump victory, what would it mean for world markets? What would it mean for the U.S.?
Not very much, because if you...
What would it be like, once the event is out of the way, you can breathe and, move on with your life?
I think people have been a little bit too concerned about the possibility of America becoming protectionist, etc. I don't think that'll happen. It's just impossible. Even if you look at the Mexican relations, the contacts are just too deep for it to be broken. Now, yes, Trump talks about making it more legalized, making sure people are registered, etc., etc. But that's all within the possibility of what we're doing anyway. So I think people may be a little too frightened by change, which I don't think is going to take place.
Would it lead to a relief rally in world markets? Whoever wins?
It could, but not really, because I think most of it is discounted.
It doesn't depend on who wins?
No, I don't think so.
No? Okay. Will the Fed move faster? Yeah, I know. You don't want to stick your neck out just...
No, I mean, I think it's very important to talk about the Fed, because I think whoever wins, the Fed is going to be under pressure. Because a lot of retired people on fixed income in America who are savers, who save money in the banks, are very unhappy.
Yeah.
And so there's going to be a lot of pressure on the Fed to take some action.
Should they? So you basically think they should, move on rates at this point?
I think it's a good idea to do that. Make that change.
It's been 8 years.
It's been very bad for the markets. If you notice, the markets have been moving, at least the major markets are moving sideways, because the expectation of a raise in rates is very bad.
Right, and that whole differentiated rate trade, where the US is, even if it's slowly and steadily hiking rates, the rest of the world is still in easing mode. I mean, just the mention of taper in Europe, had Mario Draghi say, no, we can extend it out beyond March, so don't believe that just as yet. Wouldn't that cause more volatility in the markets?
Hopefully there'll be some realization that central banks do not determine economic growth. Central banks are not able to make a country grow. It's policy. It's a political decision that makes country grow. And that's something that has to be realized.
Are you working with the assumption of a hard Brexit right now?
No. I think when it comes down to the wire, they will wake up to the realities.
So the pound has seen its worst?
Probably not. I think it's probably more to go, because the talk will continue in a negative direction.
All right. Would that also mean you making more trips to India?
Yes.
Yeah? Okay, so I just want to slip in a request now itself for the next time that you're in India to talk to ET Now. But thanks very much, Dr. Mobius, for joining us and giving us your exclusive views. With that, we come to the end of this edition of The Global View. Thanks very much for watching the show.
Find us on Facebook at facebook.com/ETNow, and don't forget to click the like button. You can also follow us on Twitter at ETNowLive. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/user/ETNow.